I'm Nicole Rashad with the Investing News Network on day one of Minds and Money in New York. And joining me right now is Chris Berry, founder of House Mountain Partners. How are you today?
I'm great, thank you.
Perfect. So, how's the conference been? I know it's just getting started, but how's it been for you so far?
Well, so far so good. To your point, I just got here, but I think generally speaking, there's some interesting sentiment in the markets that I work in with lithium and cobalt and graphite, some potential changes. So I'm just here to sort of gauge that and see if we can't get a permanent turn for the better here.
Perfect. So, what is the sentiment for investors in terms of battery metals? Has it changed since last year's conference?
Uh, I think there's a realization that this investment theme is a much longer term has a much longer term horizon now. I like to joke that with respect to battery metals, we're at the end of the beginning. To steal a phrase from Churchill, I think that those expectations, those investor expectations of 800% gains, investing in a junior that's going to make a discovery, those are over. Okay, and so now it's all about finding those management teams and those assets and those metals that are going to be pretty promising opportunities over the next like 5 to 7 to 10 years. Because I really think that's the window, that's the investment window that you need for this space right now.
Okay, perfect. So you will be a part of a panel of investing in lithium. What is one common mistake that you often see investors make when they're jumping into the space?
Well, I think that all lithium projects and all lithium that is produced is the same, and it's very, very different. And that's, I think, been one of the kind of the mental blocks that a lot of new investors, I should say, a lot of investors that are new to lithium space have to come to grips with. Lithium is not fungible. You've got different products, different purities, and it goes into a number of different markets. Obviously, the battery business is what has everybody excited, but there's still a lot of nuance there in terms of, again, what are the management teams doing out there to prove that they can produce battery grade material at scale for a number of different partners.
In Q1, we saw Volkswagen sign a pretty large lithium supply deal with a top producer. Do you forecast more of these type of deals during this year or beyond?
I do, and I think that, look, the OEMs, the Volkswagens of the world, just to use them as an example, have finally realized that, hey, there is an issue with security of supply in terms of upstream lithium access. Uh, you know, the Volkswagen deal was certainly welcome. Everyone's very excited about it. They did it with Ganfeng, one of the really powerful producers in the space right now. So I certainly think you're going to see more of that over the next, 6 to 12 to 18 months. You're going to have to for these OEMs to be able to hit their goals out in, say, 2023, 2024.
Okay, great. So why are we not seeing so far more car makers like step into like secure supply?
Well, I think that no one, whether or not you're an investor, you're a policymaker, or you're an automotive manufacturer, you've never seen this much interest and never seen this much stress along the lithium ion supply chain. I mean, I don't think lithium demand has ever grown at 20% per year for any length of time. It's always been, maybe a little bit above global GDP, 5, 6%, right? And so now all of a sudden that it looks like this 20%, 15 to 20% demand growth profile is sustainable out over the next, I'll say, 7 to 10 years. All of a sudden these OEMs are looking at each other, and it's a mixture of policy sort of push from governments in the EU, for example, or even here in the United States, basically saying, or China, obviously the 800-pound gorilla in the room, basically saying, look, you are going to electrify your fleet, and it's up to you in terms of how you do it, but it's going to be done. And so, you just haven't seen um, the demand along the entire supply chain this robust, and everyone's kind of waking up to it now.
Speaking of lithium supply, the U.S. has been taking center stage in the past few months due to its current bystander role within supply chain. Do you expect this to continue?
Well, the policy and the permitting and so on and so forth, that doesn't change overnight, and so it's going to take a while, I think. But there is a realization amongst automotive manufacturers here in the United States, as well as policymakers in Washington D.C., that we are, in some cases, anywhere from 75 to 100% dependent on import, or per imports, I should say, of these raw materials. It doesn't make any sense. It doesn't have to be that way, because if we know one thing about lithium, it's that it's not rare. I mean, you could probably, if you went to North Carolina, if you went to Arkansas, if you went to Nevada and looked at a lot of these projects that are U.S. based, you could produce, you know, over 100,000 tons of material, eventually. And that would, I'm not necessarily going to say that would make us self-sustainable. I mean, there are a lot of other factors you have to weigh, but there's no reason that we should be 95% reliant on imports of some of these metals.
Okay. Switching gears a little bit to another battery metal, cobalt. What is your outlook for 2019? With prices down, are you bullish on it?
I think longer term I am. I think 2019 for all of these metals is just going to be a year where we sort of wobble within a range from a pricing perspective. I think that 2016 and 2017 were so, quite frankly, exciting that everybody thought, hey, this is going to keep going. And of course, 2018 came along, and for a number of reasons, things have mean reverted. Certainly in cobalt, I mean, it's a really ugly chart. It's a total parabola, which is not what you want to see. But back to your original question, look, my personal view, longer term for cobalt, maybe out to early to sort of middle of the next decade, you'll see a slow grind higher to maybe the low to mid $20 per pound range. And that has everything to do with incentive pricing and so on and so forth. But I think we're going to go sort of sideways for this year, to be honest with you.
And my final question has to do with the most overlooked but needed raw material, which is graphite. So, do you see graphite momentum returning anytime soon?
I think there's obviously graphite has not been invited to the dance, right? From a share price perspective of these juniors, and I think there are a number of reasons for that. I would assume, or I would bet, for lack of a better phrase, that I think graphite and nickel are sort of the next metals to really move based on this theme. Look, with graphite, you've got challenges in the sense that there is a substitute with synthetic graphite. My understanding is that anode manufacturers are happy to blend natural and synthetic graphite, but they're not going to just take this huge right turn and all of a sudden shift production methods away from synthetic into natural. And also, you have Syrah Resources in Eastern Africa, excuse me, and if they can hit their production goals, that's going to really potentially sway the market and could put a cap on pricing. So I think the investors are really looking to see what happens with Syrah going forward before jumping in.
Okay, perfect. Well, thank you again so much for taking some time to talk to me during the conference. I hope the rest of the day and day two go very well for you. And once again, I'm Nicole Rachat with the Investing News Network, and joining me is Chris Berry, founder of House Mountain Partners. Thank you.
Thank you.